Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, comment on this podcast, and find links and other information related to today's conversation. You'll also find our archives, where you can listen to every episode we've ever done going back to 2006. Our email address is mail@econtalk.org. We'd love to hear from you. Today is September 7th, 2018, and my guest is economist and Bloomberg opinion columnist Noah Smith. He blogs at Noah Opinion. That's his first name, Noah, followed by Pinion, which we will link to. This is his second EconTalk appearance. He was here in December of 2015 talking about the reliability of economics as a science. Noah, welcome back to EconTalk.
Hey, Russ. Good to be back.
Our topic for today is corporate governance and how corporations could be run differently from the way they're run now. What are people worried about right now when they look at corporate governance and boards of directors and what corporations' responsibilities and accountabilities are?
Well, there's a number of worries. One of the main worries has been short-termism, the idea that when you have public companies, everyone's worried about the next quarterly result and no one's thinking 5 years ahead, and or even 1 year ahead. And so this could cause companies to underinvest. We have evidence that privately, closely held companies invest more. This could cause them to miss out on key market segments and just take a bunch of short-term decisions, or even, asset strip. And so that's been a big concern. Obviously, there's also a big concern about wages. Even as corporate profits have risen, wages have been relatively stagnant in America. Compensation has gone up very little, especially compared to, decades like the 1990s or the 1950s and 60s, obviously. And people are worried about that. And they're thinking, the economy is growing and workers are taking a smaller slice of the pie. And how do we rectify that? Well, maybe we can use the government to tax and redistribute. That's the typical solution. But maybe we can force corporations to have, to change their structure and have a more equitable or at least a more even distribution of the value added from their activities. So those are the two big concerns.
And we'll link to a couple of articles you've written on these topics recently. And one of them, you have a chart of the trend in compensation and the trend in corporate profits. And they diverge somewhat dramatically around 2001. Which surprised me. I hear a lot about how profits are rising lately. I'm surprised it's that length of time. Of course, profits dipped with the recession of 2008, 2007 to 8, and then bounced around a little bit. But they've been recovered quite well since then. So This is a fairly long period of time of rising corporate profits. And it might be useful just to talk for a minute about the stock market and corporate profits as a measure of, say, the economy's performance. I think a lot of people mistakenly think that those two are the same thing. The economy's growing, corporations should make more profit, or the economy's growing and that's good for companies and that's good for everybody. And when we talk about corporate profits, really talking about a particular segment of the American economy, which is publicly traded companies. It's not the whole economy.
Right. It's not the whole economy, definitely. It's just something that, people think that they can influence. So.
Well, they want to play with it, but I'm thinking about the fact that a lot of people will argue that economic policy must be doing a good job because corporations are making more money or the stock market's rising. And I don't think that's a really good measure, in particular if changes in tax. We've recently cut corporate tax rates. I expect corporations to, at least in the short run, maybe not for the long run because of competition, and we'll talk about that later, but short run potentially to make more profit. They can make more profit at the expense of customers. They can make more profit at the expense of smaller firms that might have trouble complying with certain types of regulations. I think it's important to emphasize that the health of the corporate sector is not a one-on-one correlation with the economy as a whole.
Right, exactly. And I forget who it was, but there was a great line that said, we don't want to tell people, let them eat the Dow Jones Industrial Average.
Yeah, exactly. Although, of course, a lot of Americans do own stock, which is pleasant. If the market's going up, it's always nice. But I think
it's very concentrated. I mean, stock ownership is so concentrated among the top 10% of Americans. Most middle-class people in America have most of their wealth in their houses.
Yeah, which is unfortunate for a lot of reasons. But to the extent that you have pensions, I don't know what proportion of Americans have pensions, but they, of course, are often benefiting from the growth in the stock market as well, although it may not be measured right now at this point in time.
Right. People do have pensions. People do have 401ks, and they are exposed to stocks that way. And so you have a little bit of stocks owned by a lot of people, but then a lot of stocks owned by a little bit of people. It's this very fat-tailed distribution.
Yeah, for sure. But I think it's really important to keep in mind that what I would call corporatism, that this somehow, the idea of coddling corporations, which will lead to higher profits and higher stock market values, it's not a good thing in particular. It's not a bad thing in and of itself, but it's not a goal.
Right. Yeah.
So people are worried about, in particular, they're particularly worried about compensation. The short-termism issue, I have never fully understood its source. You want to talk about that for a minute? Why do we think? Why wouldn't long-term decisions or longer-term consequences be embodied in the price of the stock so that everybody would care about the long-term and the short-term? They're discounted, of course, but they still should matter.
Maybe, maybe not. We see excess volatility is this really well-established fact. People have been arguing about it for a while, but really the evidence is pretty overwhelming.
What is it?
You see excess volatility means that you see stock prices bounce around a lot. There's a lot of volatility in stock prices, right? And then you actually say, okay, well, let's look at the actual dividends that these companies have been paying, or let's look at their earnings. Forget about the dividends. Let's just look at the earnings and see if the earnings end up bouncing around this much. And you wait for 20 years and you look at it and they never do. So, today people get really optimistic. Tomorrow they get really pessimistic and the stock price just bounces around, and then you look and you see that earnings never did the same. So imagine if you have a weather forecaster, and the weather forecaster switches his forecast. The weather forecaster is trying to forecast the forecast like 2 months away from now. And every day he switches his forecast. And one day he says, oh my God, temperatures are going to be 100 degrees. And then the next day he says, oh my God, it's going to be freezing. And he keeps switching back and forth. And then you get there and it's just, a nice even 72 degrees every day. And this guy is just, talking crazy talk every day like Alex Jones. And you'd fire that weather forecaster. And that's the analogy made by Robert Shiller, who really was the first to zero in on excess volatility and discover it, and who won the Nobel Prize for essentially that, for realizing that stock prices are an excessively volatile forecast of future earnings.
Do we have an explanation for that?
We have too many explanations for that.
No doubt, yeah.
So, and so there's many explanations. The short-termism idea is basically that, yes, I may care about, so 20 years from now, someone's going to be holding the stock, but that stock is going to have changed a million times between now and then. And in order for me to care about the long-term value of the stock, I've got to assume that every single person along the way cares equally about the long-term value of that stock so that the price back propagates. So, by backward induction, you remember that, right? Backward induction, we can say, okay, well, if the last person cares about the value in 20 years, then the second to last person has to too, then the third to last person has to, blah, 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 all the way back down the chain to me. But if that chain is broken even one time, if there's even one idiot or not even an idiot, someone who doesn't really care about the value, who just has to sell, is forced to sell for liquidity reasons or because, their daughter broke her leg skateboarding or something like that, and then pays a price or charges a price that's not commensurate with the long-term value of the stock. If at some point the value price link is broken, the whole chain is broken, And then why do I care? And there's good reason to think that that chain gets broken relatively frequently, that a lot of people actually do care about the fundamental value, but there are enough noise traders, liquidity traders, or just irrational people who don't, that this whole idea of, well, I can project forward 20 years and then every single person who ever holds this stock is going to have to equally care about its long-term value, or even 5 years, or even 1 year, given how often stocks trade these days. It's in other words, it's gonna get washed out in the market, and you're gonna have that chain be broken. And so that's why in other words, there are many possible reasons for short-termism.
Yeah, I don't understand that, but in particular, I guess my first it's okay. My first thought is let me take a different kind of example. We hear that the CEO is focused on this quarter's earnings to the exclusion of more important issues perhaps down the road. So I make a decision as the CEO to do something this quarter that leads to a horrific lawsuit in 5 years. And the standard argument is, well, the CEO probably won't be here in 5 years. The real question to me is, if you knew in advance that was coming, and some decisions, of course, you can't know, but others you can, why would I need that complicated backward induction argument? Isn't there just a simple arbitrage condition that the future value of the stock is going to be dramatically lower? That's going to affect the value today. Why do I need all these people holding the stock and all this complication? And doesn't that suggest that the short-termism is performing a different purpose? It's not that investors have short time horizons or that CEOs have short time horizons. Perhaps it's just hard to figure out what's going on in the long term, and short termism is the best we can do. The idea that somehow there are these great decisions that are being foregone because people are focused on quarterly earnings strikes me as a very bizarre picture of the stock market, corporate governance, and so on.
I can't speak to that. A lot of people, this seems extremely intuitive. The idea that people making decisions today should care chiefly about the value years from now would strike a lot of stock market participants as kind of absurd. They laugh at you. And of course, there's a big tug of war here between traders and entrepreneurs, venture capitalists, long-term people. You find almost nobody who's not vested in some way. And so if you talk to private equity people, venture capital people, they will often complain about short-termism. And if you talk to, executives who really have big plans, they'll often complain about short-termism. Look at Elon Musk fighting with short sellers on Twitter. So they'll definitely complain about short-termism. But then if you talk to, traders, they'll say, oh, no, of course there's no short-termism. Obviously, long-term value governs the value of the stock, blah, blah, blah. And so it's hard to get a neutral opinion. But when you look at research, you find a few things. You find, number one, once you take a company off the public markets and have it on the private markets, it reinvests more of its profits. And that's a pretty robust statistical correlation. Why is that happening? Why, Modigliani Miller says, and various other neutrality results in economics say nothing like that should ever happen. It shouldn't matter if you're owned by a consortium of 9 super rich people or if you're owned by 9,000 individual little stock investors and traders. It shouldn't make a bit of difference. But yet it does. And why does it? We don't know. We also see that founder-run companies invest more and also are more profitable in the long term. So that's probably why you see a lot of these great companies being helmed by the people who originally made them. So you see, Apple is headed by Steve Jobs, then they kick him out, then he leaves, goes and does some other stuff, then he comes back, then he starts running the company again, and all of a sudden it gets revitalized and, kicks major butt. You see Bill Gates, Microsoft was really a titan under Bill Gates, and then it just goes into Bill Gates sort of retires to go do his philanthropy stuff. And then you see Steve Ballmer and some other outside people or not non-founders, running the place. And then it sort of becomes this very staid blue chip company that does it, that just does its thing and doesn't grow super fast and ceded a lot of the market to Google and whatever. So you see a lot of examples of this in real life where founders invest a lot more, have these very dynamic, coherent, unified visions for their companies. So we have pieces of information on several different fronts about founder-owned companies and just about closely held companies in general, showing that like they invest a lot. So that gives some fuel to the short-termism argument.
Yeah, I'm not sure the founder argument goes as cleanly as you might like. It's interesting, relevant. Founders have different emotional issues about their own companies. Lots of stuff going on there. They're interested in taking risk. It's certainly the case that a publicly traded company is going to behave differently than a founder-run company in all kinds of directions. I'm just not sure that short-termism is the main thing there. But let's move on to the second point you made, which I think is the more interesting point. It's the one that's, I think most people would prefer that the markets not be so short-termy, but they're much more concerned about the wage issue.
Right. Yeah. And so we're talking about short-termism. It's good we got that out of the way because the real issue is about distribution. The real issue is about how much these companies are paying their people. And
so a lot of people let's actually, before we talk about a lot of people, looking abroad, America has one set of policies, legal structures, et cetera. But elsewhere, countries have experimented and tried different methods of corporate governance. And I want to talk about co-determination, which is is that the right word? Is that the way?
Yes, that is exactly the right word.
Which is the thing you wrote a column about recently. And this idea is that workers would have a say on the board, either as holding seats on the board or having influence on who's on the board. And what's the argument there? What are some of the models outside the United States that we can learn from about the impact of this?
Germany is the most famous model. And Germany is a relatively good model because it's a large-ish country. It's got about 1/4 the size of our population, but that's still a lot larger than some very small countries like Sweden or Denmark. And they have a co-determination system. Now, Germany has two main pillars of its co-determination system. One is workers' councils, which is basically a council of workers that has input into things and handles some of the collective bargaining. But that's not what's on the table here in America. The other part, the part that is here on the table in America, is that workers have representation on corporate boards. So basically, if you work for a company, you are considered a stakeholder and you get to vote for the board. Now, in America, that is not true. In America, you only get to vote for the board if you are a shareholder. So shareholders are considered the only official stakeholders who own the company. In Germany, basically, they have partial worker ownership for companies.
And what do we know about the German experience?
Well, relatively little. So we know that Germany has less inequality than we do. But there could be a number of reasons for that. Germany is a smaller country with less regional inequality. Germany has, a different education system and blah, blah, blah. So it's relatively
there's
difficult
only about 1 million, maybe 1.5 million factors that are different in Germany than the United States, besides that they have co-determination. So, yeah.
Exactly. And it's hard to, sort of look at these aggregates and say, okay, well, Germany's doing better. We better just copy everything they do. That's cargo cult thinking. Right? Cargo cults, right?
I do, but why don't you explain it? So
cargo cults were this relatively short-lived phenomenon. In World War II, American military would land on all these islands and bring awesome stuff with them. And then eventually after the war, they just left and stopped doing that. And some of the people there thought, well, how do we get this stuff back, and how do we make these planes land again and bring us awesome stuff? And so they sort of made facsimiles of air traffic control equipment and, made a religious cult and made, fake planes out of straw. It was, it wasn't that common of a thing. It happened on a couple
It maybe never
islands.
Happened, but it's such a good example.
It did happen somewhere, but so I don't want to, stereotype the poor island people of the South Pacific.
But it's a Richard Feynman story, if I remember correctly, right?
Yeah.
The physicist. He used this as an example of illogical. It's actually a fantastic example of misconstruing correlation for causation, right?
Exactly.
When you had a lot of planes on your airport, you got a lot of goodies. So let's put a lot of fake planes and make it look like an airport. Or better, let's build an airport. If we build it, they will come. But of course, it doesn't work that way. Okay.
Right. And and so that's so we can't. It's hard to look at aggregates in Germany, and so there has been research on co-determination and looking at companies that are subject to co-determination, and that research has been somewhat mixed, actually. So you can do a cross-country regression, see that countries with co-determination in general, not just Germany, do tend to have lower income inequality. But again, that's a pretty blunt piece of research. You can look at you can just compare at the company level, companies that have labor representation on their boards. And again, that's looking at correlation, not causation. So that's important to realize. But some papers find that companies with labor representation on their boards do have lower stock market value, and that implies that workers are successfully extracting some of the value from shareholders and redirecting it to themselves, which is exactly what the proponents of co-determination in America would want. It's saying, well, if you give workers seats on the board, they're going to use it to press for higher wages and lower profits while keeping productivity similar. And some people do actually find evidence of that, but then some other papers don't find that, and they say, well, actually, there's just no relationship at all, no correlation, so it's a wash. So it's not clear. You don't seem to find anyone who thinks that that co-determination results in worse wages for workers. That's not a thing that anyone has found.
But you could, right? You could. That would be a possibility, because it could be that workers are very worried about the long-term stability of the company. They value their job security, and so they're willing to take lower wages for higher profits to make sure the company survives above all else. Right? That's possible.
That's right. It's theoretically possible, and so that's one of the things that makes this very hard to study, because you can use profit as just a way of distributing the value added to the shareholders and saying, here, rich people, take your stuff, go buy a yacht. Or you can use high profits as essentially a cushion. And you can say, well, we have this very volatile manufacturing-based business, as you do in Germany. And this year we might sell a lot of cars, and then next year we might not sell any cars. And so we're going to make sure that when we do sell cars, we make a bunch of profit so that we have this cushion so that we don't go out of business in the years that we don't sell many cars. And so that could be a thing that's going on too. And it could be that high profit margins could act as a sort of cushion for bad times for a volatile business to make sure that you maintain high labor employment, that you maintain high employment levels, which Germany's also been focusing on in the last couple of decades is raising employment levels. And you're absolutely right about that. So another thing that co-determination can do, actually, which isn't really being talked about in America very much, is that you can get better worker input. And, so workers kind of know how things work on the ground. There's another Feynman story here. So Feynman is legendarily reputed to have solved the Challenger disaster and and to have figured out that it was the O-ring in the Challenger that blew. And if you read his memoirs, what he mainly just did was go talk to a bunch of engineers and say, hey, engineers, what do you think is the weak link here? They said, oh, the O-ring. So he grabbed a piece of O-ring and he put it in a cup of cold punch, and then he crumbled it in his hand, and it was this very dramatic moment. And people thought, oh, Feynman, what a genius. Well, really, he just went and talked to the guys on the ground. And there's a chance that if you give workers more input into the running of the company, they will know what needs to be done to raise productivity, because they're the people on the ground. They're the people close to where the sausage gets made. And so actually there have been a couple papers showing that the companies with more workers on their board do have higher productivity over the long term. But that's correlation, not causation. So you could basically, that could be because more productive companies tend to put more workers on the board to the degree that they have voluntary control over it. Because there is some variation between, Germany says, well, you have to do this, but then some companies do it more, and then some companies in other countries do it more just on their own voluntarily. And so some people argue that voluntary putting of workers on the board is just a good thing, and this is a thing American companies aren't doing, but are legally already allowed to do on their own, and we shouldn't actually force them to. Instead, we should just sort of disseminate information about how that could be a good thing to do.
And you suggested that since we don't, and this summary is very nice, and one of the things I like about Noah, and I follow Noah on Twitter, and he's one of the, so even though we don't agree on a lot of things, he's extremely honest, and he doesn't, as far as I can tell, it's of course hard to tell, but as far as I can tell, you're often saying things that don't necessarily go along with your priors. You're summarizing research like you just did. You don't try to whitewash it and sell it in a particular direction. You point out that it's mixed, which is really good. You also point out that since we don't know everything here, we might play around with some tax incentives to encourage firms to try this.
Right. Yeah, so we could just nudge. I know that you're not the biggest fan of the nudge concept, but maybe if we're talking about an organization rather than an individual, you might be more amenable.
No, not really. But go ahead. I'll give you a shot.
We could nudge companies and say, "Hey, companies, we're going to try out this thing where try putting some workers on your board, and we'll throw you a little money if you do, and try seeing how that works." And then some companies will say, "Bah, we don't want workers on our board," and then some companies will say, "Oh, well, we'll try that. Maybe our workers do have some important input," and they'll put the workers on the board, and they'll say, "Actually, we learned a lot from these workers, and that was pretty good." And it's not just turning into a big labor versus management shouting battle like a lot of union battles did in the mid 20th century. Instead, it's actually just workers who care about the company and now feel more vested and feel more of a stake in the operations and have useful insight to offer to management. And so I think that it should probably start there. And then, if that works, if the companies who do it succeed, then we could start thinking about, scaling up that program in some way, or maybe it would just spread on its own and we wouldn't have to. So,
Yeah, I think it'd be an interesting cost-benefit analysis of whether you'd be better off spending that money and giving it to the workers directly and just say the subsidies and just giving it to them and saying, here, have more money. Right. Depends how much money it would take to encourage this trend. It's hard to know. Let's turn to a different issue, which a lot of people have lately picked up, to my fascination and somewhat surprise and somewhat horror, which is this idea that monopoly power is spreading in the U.S. economy, that's the explanation for these higher profits, and that this also might explain the wage stagnation. Of course, longtime listeners know that I'm skeptical about the existence of wage stagnation. So I'm taking that as, I think it's false. I think it's a misreading of the data. Yeah. If you want to talk about that, we can talk about it for a minute. But
I think we should talk about that actually, because if that's not happening, then this discussion is a little silly.
Yeah, but everyone assumes, besides me and about 7 other people, thinks that it is happening, and so they're trying to solve it, fix it, improve it. And well,
let's talk about it.
Okay, we'll talk about that first, and then if we have time, we'll talk about. So, what would you say is the evidence that wages are stagnating?
You look at the government data.
Yeah,
the government does a bunch of surveys about this, and the surveys are collected in different ways, which I think is important because that minimizes the chance that you're looking at a methodological error. And you look at decades, you don't look at months. I've sometimes against my better judgment showed the most recent data point, and then that's overinterpreted.
Yeah.
But because obviously that can easily get out of hand. But if you look at decades, you can look at the real compensation. You can look at the employee compensation measure.
Yeah.
Yeah. You can look at average hourly earnings. That's another measure.
Not a good one. Look at. Go ahead.
Well, I mean, the point is that none of these are perfect.
Right. So, let me just comment on this.
None of these are perfect. So you look at a bunch, and
right.
so the average hourly earnings does contain important, information. It's not, it's not a full picture of what's going on. You can also look at median real weekly earnings for full-time employees is another popular one.
That's a good one.
And so those are three measures that I always look at. You have the Atlanta Fed's wage tracker. That's another one. That's a smooth, moving average. So that's just yet another measure. And then you have some more measures besides that. And they all show the same thing, which is that, since the turn of the century, we haven't seen a heck of a lot of action in wages. And ironically, we have seen a little bit of growth in 2014, 2015, and then a little bit again in 2017, although that then looked like it kind of reversed. We've seen a little bit of growth since then, but mostly since the turn of the century, we've seen very little action at all. Now that's, we're in the 18th year since the turn of the century, or I guess we've had 17 years of data. And that's a decently long time. I mean, I'm not willing to call 17 years a blip. And we do see a lower rate of growth than we saw in the 90s. The 70s were tough. That was a tough time. We saw a bit of, some growth in the 80s, and then robust growth in the 90s. And then, of course, we saw robust growth in the 40s, 50s, 60s, et cetera, et cetera. We haven't seen a heck of a lot of growth this century in any of these measures. There's really nothing that, and that doesn't change whether you look at, inflation, or, if you use a different inflation measure. You can use PCE inflation instead of CPI inflation, and then you get a little better growth. Yeah, it makes a little bit of difference, but it doesn't change the fact of the slowdown.
Oh, but that's two different questions. So there's here
and when you say stagnation, it doesn't mean that wages haven't gone up at all, because they've gone up a little.
Yeah, a lot of people think they haven't gone up at all.
Right. And I think the people who say that wages have actually fallen since the 70s, that's a piece of popular conventional wisdom that I disagree with. Okay. They have gone up pretty robustly since the 70s when you look at total compensation and you deflate it right.
Correct.
So that's not a talking point of Noah Smith.
Hey, excellent. It's other people's talking points.
It's other people's talking point, and I don't buy it. I don't believe it, and I've written about how it's not true.
Good for you.
But I do believe that there's been a slowdown in wages in wage growth since the turn of the century, and that slowdown is marked and observable. I do believe that's true.
I'm open to that, and I think would be a productive. The next time I'm back in the Bay Area, we should sit down and we should film video. I'm not kidding, actually. I'm serious. I think this is a really good idea.
I'm into it. I like it.
We should film you and I looking at the data and talking about it and saying, yeah, well, but what about this or what about that? Because I think a lot of the times what people do is they just pick their favorite series. And I joked about average hourly earnings being bad data, because if you look at average hourly earnings since real average hourly earnings since, I think, mid-70s, it's flat. And part of that's because it's deflated with a particularly inaccurate, when it's often presented, a particularly inaccurate price deflator. It also isn't the whole economy. There's a lot of reasons to worry about one particular data set. You're absolutely right that you want to look at a few. When I've looked at a few, and the video idea I think is really interesting, because it's like being in the kitchen. It's like saying, oh yeah, I ran these numbers and look what I found. And I don't show you the 50 I ran that I didn't like or that didn't make my story look good. And if we could video our conversation where we pulled out the different charts and actually had to be accountable for what we pulled out, I think we both learned something, which would be really good. And the point I would make about the different series is that you're absolutely right, that you don't want to look at one. There's a lot of reasons. Average hourly earnings, for example, doesn't include non-monetary compensation.
Right.
The ECI series looks at all forms of compensation, but you could argue that some of those forms maybe you can't spend, so it's not so helpful. It's not the only thing people care about.
Here's the limitation of ECI is that if healthcare simply gets more expensive but yet doesn't improve in quality terms,
Yep.
then if the reason that healthcare gets more expensive is because we have an inefficient employer-based healthcare system that shovels extra money that is that into this healthcare system, if both those things are true, then people don't really care that they're getting the exact same health services and someone's getting more dollars, and they don't see the input or the output. People see their take-home wages and they see their take-home benefits, and they see I'm getting the same amount of doctor visits and I'm getting the same amount of surgeries and I'm getting the same amount of medicine as before, and yet it costs more, so my wages have gone up?
Yeah, so the problem with that point, I agree with that point, which is what I was alluding to, but the problem with that point is that that's not what we're using the data for. You're making the point that, people aren't going to actually be better off, and you're right, because we have a lousy healthcare system, the way it's structured and organized. Then we wouldn't want to use the flatness of, say, take-home pay or monetary compensation to then say, well, we have to use that because people can't spend their healthcare insurance. They're just being stuck with the fact that their healthcare benefits are chewing up a larger and larger portion of their compensation. Right. That's true, but that wouldn't be an indictment of, say, the American corporate system. It'd be an indictment of the healthcare system. So I think you do want to look at ECI, not by itself,
but
you
other
do.
Things. No question.
But other things.
No question. You do want to look at ECI.
Now, the point you're making, which I also want to concede, is that I tend to focus on the 1970s to the present. I'm going 4 decades because as you point out, you don't want to look at a blip or a year. I also agree, but I agree with you that since 2000, that's important. It's not zero. It's not a short time. And I'm willing to accept the possibility, this is where I want to sit down and we'll go over the data, that there's actually been a slowdown, but it's not stagnant. And so this relentless argument that I hear that I'm just frustrated with, that all the gains have gone to the rich for the last 40 years, I think is, quote, not true. And so that's the only point I want to make there. I'm willing to concede the possibility, I've not looked at it lately, that the last 17 years have been different.
Right.
For whatever reason.
And in the last 17 years, we've seen, you looked at this explosion of profit. A lot of so that's been an interesting juxtaposition over the last 17 years, is that we've seen corporations making a lot more profit, a lot of it from, overseas operations. And then workers, we've seen this wage slowdown at the same time as companies are making a lot of profits. If you look at simply domestic value created, you actually see the same trend, but less marked. So if you look at just the profits that are being made, domestically, and of course there's a lot of accounting issues in that because companies do a lot of profit shifting, for tax reasons. So it's not super reliable. But if you do look at that, you still see this rise in the ratio of corporate profits to wages since 2000, and there looks to be a very clear inflection point.
So as long as we're clear that it's not stagnation, that's just drama.
Well, hold on. When I say stagnation, what I mean is
slow down the rate
trend
of growth.
Break, a slow down the rate of growth. I do not mean zero growth.
That's what stagnation means, just FYI. It's like when people say that budgets have been slashed and they mean, the rate of growth. I don't think that's I think those are.
Oh, no, you're right. Slashed is something else. But if your wages grow, 7% over, 2 decades, right? And then previously, or 5% over 2 decades, something like that. And then previously, your wages had grown in many previous decades by, 15, 20%. And now you look at this extremely slow rate of growth. I feel justified in calling that stagnation.
Okay, we'll leave this at that. This is not,
I just want people to know what I mean.
Good. That's good. This is not English.
So when I look at Wikipedia, it says economic stagnation is a prolonged period of slow economic growth.
Well, that's
so extending that to wages. I don't know. It's a point that people shouldn't argue about because it's easier to just look at a graph and see what's going on.
Yeah, I think it's important to keep our terms straight and to be clear. And so we now are clear that you mean a slowdown in the rate of growth. And
a dramatic slowdown in the rate of growth.
Fair enough. Potentially.
A substantial slowdown, yes.
Potentially. Again, there could be other factors. It could be, just to take one, it could be that the incredible innovation of the last 17 years in the tech sector has made the price indices we use less accurate, and that's part of the problem, right? Could be. But let's put that to the side for now. I think we've made it clear what we think the state of the data are more or less. And let's turn to this question that a lot of people are suggesting, is that this slowdown in the rate of growth comes from increased market power on the part of corporations. We had Matt Stoller on the program recently making that case. What's your view of that claim?
It's uncertain as to whether or not that is the culprit. And it's a big question that is completely unresolved. So you've got people at the Economic Policy Institute basically saying, no, this can only be a tiny part of what's going on. You've got Jason Furman, Obama former economic advisor and current professor, I believe at Harvard. I always forget where Furman is at. Anyway, he says, yes, it's only a small piece of the wage puzzle that's going on. And then other people say, oh, well, it's actually a big piece of what's going on. You look at, and sometimes they're not talking about wage stagnation so much as the reduced labor share of income. So you've got, David Otter's paper, and you've got a couple other papers talking about that. You've got Simcha Barkai's paper. And so they say, oh, well, actually decreasing labor share comes a lot from, concentration, or at least from increasing rent extracted from the economy.
So that's a strange argument. So let me try to make the argument, or what I find. So let me try to make what I find troubling about the argument. The claim is, and it's often combined with a focus on the tech sector. The tech sector has certain non-competitiveness aspects to it. So, for example, some people on the right complain that say Google doesn't give a fair shake to conservative sources when you do a Google search. And of course, one answer to that is, well, start your own Google. If you don't like Google, start your own competitor. And it's hard to start a competitor. We understand that. It's hard to start a competitor to Facebook. Having said that, they may disappear. There is a competitor to Google. It's called DuckDuckGo. There's others, I'm sure. Bing.
I didn't even know that existed.
I know, but Bing is out there, DuckDuckGo. And I always like to point out, DuckDuckGo promises they won't use your, share your information, and everybody thinks, oh, that's great. Of course, you have no idea if it's true. I just don't know why. The fact that they claim they don't share
Google is probably sharing your information.
Yeah, Google is. At least they're honest about it. So if you're worried about these things, if you're worried about the concentration in the tech sector, say, of social media or search opportunities and the ability of those to be manipulated, that's legitimate. I think that's a real interesting issue. It's a worry. It's not clear it has the same impact. I mean, I don't see any reason that it would have an impact on wages. And in particular, what we're talking about is monopoly in product markets, not monopoly in the competition for the services of the people who work at these companies. In fact, I'm going to just pull – I'll never do this. No, I'm doing this for you.
Okay.
Just earlier today, in the last hour and a half, you retweeted a graph. As I mentioned earlier, I follow Noah on Twitter. You retweeted a graph that shows that the share of national income captured by the San Francisco Bay Area is way up, while its proportion of employment is basically flat or a little bit down. And I'm not going to really claim that that's proof that high-tech companies have been treating their workers very well. But I think they do treat their workers well. And I think it would be hard to argue that workers in these companies that have so much alleged monopoly power are somehow being exploited as employees. I just don't – what's the evidence for that? Either theoretical or actual?
I mean – the evidence that – wait, so what's your question again? Can you restate that question?
Yeah, so I understand that people are worried about dominance by a small number of firms in, say, the market for information, that social media is very concentrated. Right now, Twitter, Facebook, and Instagram have a very large share of the market. I understand that Google has a very large share of the search market. That has cultural and social implications that I don't think we fully dealt with, understand, and we're going to have to see how it works out. But I understand the argument. I understand the argument. I'm worried about it, but I understand the argument that says these are like public utilities we should regulate them. We should demand that Google say, or Facebook say, give equal representation to all political viewpoints. I don't really like the government doing that. I don't think that's a great thing, but we'll see. We'll see how this turns out. But having said that, I don't understand the argument then that this dominance in consumer markets like search or social media means that they're going to exploit their employees, and that growth of monopoly power is keeping down wages in the United States. Just doesn't – I don't get it. Help me out.
All right. So there's a number of issues to unpack here. One is that you talked about the tech industry, but the tech industry, despite having a spectacular market capitalization, is a relatively small slice of employment and revenue in the American economy.
Excellent
value
point.
added.
Excellent point.
Tech is everybody has put all their money into Google and Facebook and Amazon and whoever, but it's actually like most of the American economy is still stuff like, agriculture or like food processing or construction or random services like education and healthcare. Healthcare, real estate, business services, consulting, sorry. Insurance plus consulting equals insulting.
Yeah.
Retail. Like you could just list off all the sectors.
Even manufacturing.
And so when, air travel, I don't know. And so when you look at all these sectors, like tech is this high profile, small sector of it. And so I don't like to focus too much on it. If you look at the employees, if you wanted to look at the tech sector and you wanted to look at who wasn't getting paid very much, you wouldn't look at Facebook engineers because they get paid great. They get paid big bucks, but there's only very few of them. You'd want to look at Amazon warehouse workers. That's who you'd want to look at.
Yep.
There's a ton of them. And Michael Mandel has said this is the future of retail employment. So instead of, working in a store, jockeying at cash register or whatever, you are the working class person of America is going to be working in the Amazon fulfillment center instead. If we want to talk about tech employment and low wages and large companies, that's what we would talk about. But I don't. I don't want to focus on that because so much of the American economy is not that.
Correct.
Is not tech at all. And it's just we focus on the stock market so much and we focus on these tech companies because we've pumped a lot of money into their stocks. So anyway.
So outside the tech sector and
outside
the economy,
sector,
where's the evidence that monopoly power is growing in, say, retailing or retail employment or consulting services or haircutting or whatever?
All right. I will go over the evidence. So there is actually quite a lot of evidence in terms of correlation, relatively thin evidence in terms of causation. And that doesn't mean that the evidence is wrong or that the phenomenon isn't happening or that we won't be able to prove the phenomenon is happening. But it just means that it's hard to know in this area. So what we've seen are this. So number one, we've seen that that across the board in all sectors, markets are becoming more concentrated. You're seeing a few large players where before you saw a lot of small players. And this is happening, in sectors like, in food processing, Tyson processes like all the chicken. Monsanto provides all the seeds. And you see a few of these very dominant companies in these sectors that we don't think much about. Weirdly, construction is not super concentrated, but that's an exception. But then you see a lot are really concentrated, and
but that's on the product side, right? So
that's on the product side. And so what you see, well, hold on. And what you see is that in those industries where the product side is more concentrated, you've seen labor's share of income also fall more than in industries where it's less concentrated. So in industries that have become less concentrated, that have not become more concentrated, you see that labor's share of income tends to be higher than in industries that have become more concentrated. So there's a correlation for you. That's piece of evidence number one. Piece of evidence number two, we see markups increasing across the board.
Should I be impressed with that first piece of evidence, Noah?
Should you be impressed with it?
Yeah, should it like rock me? Should it rock my priors?
It should concern you a little bit. I mean, I don't know. I don't know what your priors were, and I don't know how easily impressed you are.
I'll let you keep going. Go ahead.
I'm almost never impressed by anything, so it's hard for me to say. I like to think of evidence as sort of, more like building a case, more like, less like thunderclap paper definitively proves X, and more like, we have 100 papers that all sort of point in the same direction.
Good for you.
It's starting to look like this is going on.
You're a good man.
That's my approach.
Yep, you're a good man. Keep going.
Thank you. Anyway, so we also see markups increasing. So we see that companies are, no matter how you measure cost, and there's lots of different ways to measure how much cost companies are actually paying, no matter how much we measure cost, it looks like companies are across the board in a large variety of industries in the American economy are starting to charge higher markups above whatever their costs are. And that could be for several reasons. That could be because companies are just getting much more productive and selling stuff for the same price, but able to produce it for much cheaper because they're inventing better production technologies. But that's kind of against the evidence that there's this economy-wide productivity slowdown that we see. Productivity slowdown means if all these big companies are super efficient, and we see, and there's a correlation of concentration markups. In industries where you have more concentration, we're seeing more markups. And why is that happening? If it's because all these super big companies are becoming much more efficient through mergers, then why do we see an economy-wide productivity slow down? Doesn't make sense. Another possibility is that these products are just higher quality, so that people are selling stuff that's better, and so people are willing to pay more for it. And so these unobserved quality improvements that aren't captured in official rates of inflation, whatever, are actually driving these higher markups because actually you're just selling awesomer products. That's actually a possibility that we can't rule out. But another possibility with these higher markups is just that companies are squeezing their workers more. Big dominant companies are able to squeeze their workers more and able to charge consumers higher prices, so you can or squeeze suppliers. So you can squeeze your suppliers, you can squeeze your workers, you can squeeze your customers, but that basically squeezing is getting done. And that's many of the explanations for higher markups revolve around the sort of squeezing, and that would explain the sort of correlation between concentration and markups. So that's piece of evidence number 2. Piece of evidence number 3 is that people are starting to look locally because we have all this better data now. We are able to look at localities. We have the internet now. We can look at how many people are posting job postings within like this town, or within 10 miles of this point, or within 2 miles of this point, or within 100 feet of this, whatever. I don't know. So we're able to look locally, and local stuff matters a lot because nobody wants to have a 2-hour commute each way across town to work. So it matters how many employers there are within, a mile or 2 of your house. And so there have been several papers that showed lower wages and higher prices in locally concentrated markets. So for example, suppose you're like a welder and there's only a few companies in industries that employ welders within a few miles of your house. We see that your wages tend to be lower than welders, all else equal, controlling blah, blah, blah. Your wages tend to be lower than welders in places where there's many people who employ welders within a few miles of your house. And again, that's correlation, not causation. But it's a scary correlation.
But wouldn't you think that as people move more into urban areas, which is a very long-term trend in the United States, somewhat maybe being reversed a little bit lately as housing prices get out of control, but there's still a lot of people moving into urban areas where there's lots more choices for people to find work. You'd think that would go the other way. There'd be a lot more opportunities to. I mean, just for example, if you look at some evidence by Jed Kolko,
the urban private sector like urbanist economist who has spent a lot of time looking at these trends, the move back into the cities was a pretty small move and concentrated in one decade, the 2000s. Overall, the move to the suburbs has continued, and suburbs have much higher natural rate of population growth because people in cities don't have any kids.
Yeah, but even the suburbs, there's often ways to get – like I live in suburban Maryland. It's easy to go work in downtown D.C. Most of my friends do. It's 20 miles away, and I'm here in the comfort of my own home, although I have to concede I've turned off the air conditioning to reduce the background hum. So it's not that comfortable on a 90-degree day, but the sacrifices I make for EconTalk are often not fully – no, but
that's why you should move to San Francisco, where the fog naturally cools everything in the summer.
It's true. But my point is that I think if you think about the general job market that people are in. And in particular, if you think about the fact that Walmart, which is, for example, is not a small employer, a very large employer, employs, I think, around 1 million people, something around 1 million people. Mm-hmm. They've moved out of smaller towns or stayed in those smaller towns, but increasingly entered into metropolitan markets. And those metropolitan markets, they're in competition with lots and lots of other firms for those workers. So what I want to focus on is the squeezing thing, because
well, no, hold on. Let me explain why that's not.
Okay.
So if you have overall concentration increasing in every industry, then you have industry-specific concentrations probably increasing in most localities as well.
Yeah.
In other words, if you have only 3 chicken processing companies or 2 chicken processing companies, or mostly just Tyson really, where you used to have 1,000, then that stands to reason that in a lot of areas where you used to have a couple chicken processing companies or 3 chicken processing companies that someone who works in the chicken processing industry could go work at, now it's just one. Unless you're going to switch industries and spend all the time and effort to retrain yourself or whatever.
That's the problem.
It's Tyson. That's only game in town.
I don't agree
only
with that
game
argument.
in town is Tyson, and then they're going to be able to pay you a lower wage because it's just so hard for you to switch.
It doesn't work for me. Here's why. So
why not?
Well, because let's go back maybe 30 years ago, when there were maybe in any one city there were 5 or 6 or maybe even more equivalents of Walmart. I'm moving away from chicken processing. I'll come back to it though.
Let's look at retail. Okay.
I'm not cheating. Yep. I'm not cheating on you. No, I'm going to come back to Tyson's for you, but you'll. I think it's easier to see. So it used to be there was Target, Walmart, Kmart, and usually a lot of small local stores that competed for general retail, what we department store type customers. Those local ones died. They all died. They couldn't match the inventory control. Probably other reasons, but the main reason that I see is that they couldn't match the inventory control that the larger chains had, and that suddenly was a crushing cost advantage for the larger firms. Within the larger firms, it got harder. So,
no question.
So
you're right.
Kmart might be. I think is Kmart gone? I don't see him anymore. Target's still
Kinda
around.
dead.
Target's around. Sears is struggling. Macy's, all these firms, a slightly different market than Walmart, Kmart, et cetera, Target. But those markets have gotten more concentrated. I actually would think that the prices have gotten lower, not higher. They don't. Walmart hasn't been able to exploit the fact that it's driven out the smaller local-based discount firms. That when you tell people that, they suddenly say, "But they will." When they're the last one saying, "Well, we'll see." I don't think that's what they actually do. But
they make a lot of profit.
They do, because they're really good at driving down costs. Now,
yeah, what
they're delivering.
What percent of cost? All right, what are costs? So you have inventory management costs, you have warehousing costs, you have all those kind of costs.
And you have labor,
land costs. But what is your biggest cost by far that is more than 50% of your cost?
Labor. Now,
and when people say these companies are gaining market share because they've become more efficient, because they've driven down cost. That is almost always saying you're paying your workers less, which is not contradicting the evidence that I was just telling you.
I don't think they're almost always. I don't think that follows.
Because labor cost is like 60% of cost.
Only 60. That means you've shrunk the other 40. And I'm going to make the case.
You can shrink the other costs without shrinking labor costs.
Yep.
But it almost never happens. When you have one cost factor that's 60% of costs, it is rare. It is possible, but it is rare.
I disagree.
To see costs. Well, on what evidence? Do you have any evidence? Any evidence at all? Because I have evidence showing that labor costs go down.
Just intuition.
I have evidence.
I'll come back to that in a sec.
Just intuition?
I'm not done with that. No, I got some good intuition. Trust me. So here's
why labor costs are not shrinking, but all the other costs, they're managing to shrink all the costs except labor?
Yep.
No, because then, I have direct evidence against that and direct evidence against that.
Let me finish my argument. And then
I've already told you the evidence against it in this podcast. So the idea that labor share has decreased in industries that have become more concentrated indicates that it's the labor costs that are being driven down. That's the Otter evidence.
Okay. that could be. I don't remember that paper, so I'll have to
Wait,
look
they're
at
concentrating on the fall of labor share? Like the David Otter paper about the concentration versus labor share?
I'm going to look at it. Hang on.
Okay. Sorry. Anyway, I just wanted to not go on before we made that point. Well, the point is that we've already presented evidence that they are holding down wages.
Well, I don't know, but let me finish my argument, which is the following.
Okay.
I'm an employee of Target, Kmart, local firm, and my firm goes out of business. Okay. Now I'm stuck working I have a smaller set of retailers who can employ me.
Right.
My argument, by the way, would be that it's easy to apply technology to lower all the costs. And let's think about that slowly. I can employ technology to reduce my inventory costs. It's obvious that all these firms have done that. I can also employ technology to lower my labor cost. And the way I do that is I pick a different mix of workers. I find a technology. To take an obvious example, if I'm McDonald's and I can have my cashier push a button rather than actually work a cash register, I don't have to have as skilled an employee. I'm going to have lower wages as a result, but I'm not squeezing anybody. I'm taking a different kind of worker than I had before. But the point I was trying to make before you jump down my throat with that empirical evidence.
Sorry.
It's okay. The point I was trying to make is that just because and this is my Tyson's point also, just because I can't work at Kmart anymore, Kmart actually is out of business, doesn't mean that I'm stuck working at Walmart. Just because my Tyson's opportunities have gotten smaller, my chicken plucking opportunities have gotten smaller, is that most of the people who work in these industries we're talking about don't have very specialized skills in these areas. They have lots of employers they can work for. Their wages are low because their skills are low, not because they're being squeezed. That's my point.
Okay, fair enough. And so basically, the case where local concentration really, really lowers wages a lot is where you can't move locations and you can't move industries. You're basically completely immobile. You're forced to keep doing the same job in the same place forever. And that's the idealized case. That's not real. In reality, you do have some ability to do something else. You can say, well, I can't work as a clerk in this retail store. I'll go work, on construction, or I'll go work
in a different store
as a waiter or whatever. And so, clerk in a different store. No, that's not what we're talking about. What we're talking about is switching between locations and switching between industries, not switching between employers. Because remember, we're talking about the case where there's fewer employers to switch to in the same industry, in the same location.
Yeah.
So if you can switch locations, if you can say, well, there's not many stores here, so I'll just move to LA where there's a lot of stores. Okay, fine. Then you can avoid that. It's hard to move to LA. It's expensive, blah, blah, blah. We could talk all day about the reasons why people don't all just uproot and move to LA.
We talk about it all the time on this program.
Right. And so that's one thing. And so in terms of retraining for different industries, moving to different industries, jocking a cash register at a retailer is a fundamentally different thing than stacking bricks for construction or waiting tables.
100% agreed. But it's
not 100% different. You can do it.
I'm agreeing with you. Say yes. I'm agreeing with you.
So retraining industry is not impossible, but there's barriers. So it's just the question. There's frictions, I
agree with that, but it's not retraining industries. It's retraining. I'm asking about the possibility of you can change industries and still be a cashier. You're talking about, right? It's the job that you have, that the skills of that job, which I think again are sometimes relatively straightforward and not very specialized. You can do that in lots of different industries. You do it in lots of different firms within an industry, but more than that, you can go outside the industry. You don't have to stay in the same industry. And in metropolitan areas, there's lots of choices like that.
But the point is there are less choices maybe than before.
Yeah, I don't think I agree that there could be fewer, but it doesn't mean there aren't enough to compete. I don't think it's not this dramatic 4 down to 2 to 1.
Think on the margin though. Just think on the margin.
It doesn't work on the margin. If there's 2,000 that are much bigger if there's 2,000 that are much bigger instead of 8,000 small ones, there's still going to be the same demand for labor. And I'm not sure why that's going to therefore be a less competitive labor market.
No, but I'm talking about, I don't know about 2,000. There's not 2,000 employers. I live in San Francisco. I live in the middle of a big city, and there's not 2,000 people that I could walk out and work for.
No, there's quite a few though. Actually, even for you,
even
Noah,
with my amazing, super high skills,
with your limited skills,
with my amazing high versatile skills and my natural genius that allows me to learn anything in a week, I still don't think there's 2,000 employers for me.
I'm calling Bloomberg. I'm calling Bloomberg, and I'm telling him that you're overpaid. Obviously, because you have limited choices.
Don't tell him, Russ.
Okay, I want to read a quote from your paper. From your essay that I think is a nice thing to close on. You quote Alan Kruger. You say the decline in union representation and the erosion of the real value of the minimum wage have contributed to the significant rise in inequality and polarization of incomes in the U.S. since the early 1980s. And then you write, Noah, which I thought was very interesting. Kruger also notes that structural changes in the U.S. economy, the rise of non-compete agreements, temp staffing agencies, and outsourcing have aggravated the situation. Now, there's too many things in there to talk about. Okay. I don't think that the declining representation has anything to do, since the 1980s, has anything to do with the change in income and wages, or very little to do.
Maybe not. Maybe though.
But the point, I want to focus on a very small thing, an aside that you wrote in here, which is temp staffing agencies.
Oh, yeah.
When people think about temp staffing agencies, and I just think this is an incredible opportunity for a journalist or an economist to explore, and I think it's an incredibly important aspect of our economy that almost no one's noticed. Kruger's noticed it, but that's the level of notice. Oh, by the way, there's also this temp staffing thing. So when people think about temp staffing, I think they often think about a secretary has an illness and is going to be out for a trip and is out for 3 days. So we're going to call a temp agency to get a secretary and to answer the phone for 3 days. That's not what's driving the temp staffing phenomenon that I think Kruger is talking about or should be talking about, which is the fact that there are numerous thousands, hundreds of thousands, millions, I don't know the numbers, I've never seen a study of it, of people who work for employers. They show up for work. They work at this job. It's not temp. They work there for a year or 6 months or 2 years, meaning if it's temp, it's not what we usually think of as temp. And instead of being directly paid by the employer, they're paid by an agency. That agency takes an enormous share of the compensation, a shockingly large share of the compensation, which suggests that there is something inherently unhealthy right now about our labor market, about either the legal environment or the regulatory climate or the provision of HR services that has made it profitable for companies to pay agencies an enormous premium so that they don't have to have those workers directly on their payroll. And I just think this is an incredibly important issue. I don't know what's driving it, and I wish people would pay attention to it.
Yeah, it is weird. I agree with you that I do not know what's going on there.
Okay, well, I
have no idea. But it's worth looking into. I will look into it and see who's done research on this. I put that in there because it's sort of this casually known fact that temp agencies pay low. But why that's actually happening structurally is something I'd say we don't really know.
Again, the interesting thing isn't the how much they pay the workers. It's how much their firms pay them for those workers, the gap between the cost to the employer
and the payment to the temps themselves.
And that's it's a shocking premium. And
it is.
It's not because they're nice. There's to the temp agencies. The temp agencies are providing a service that is of value that is they're middlemen that are not that I haven't seen anybody try to understand. I think it's really important.
Yep. And there's all kinds of things in our economy that have these industrial organization effects that we don't understand. And that's why this very traditional way of thinking of employers as these this huge number of essentially atomistic employers, which are essentially wage takers and forced to pay the going market wage and have no wage setting ability, I think we must be very skeptical of that mental model. And the idea that there's 2,000 employers that I could walk out and work for, very, very skeptical of that model, especially when we see things like the temp agency effect that you just talked about. There's so many strange industrial organizations in our country. There's so many strange industry organizations that end up with, huge premiums, huge wedges, huge markups, weird anti-competitive stuff. The fact that real estate commissions, I'm just randomly rambling at this point, real estate commissions have been, this fixed percent commission and finally starting to come down after so many decades. How did competition never cut that in this country? There's so many things like that you'll find in our economy, so many mysteries I
have an answer to that, of course, but we're not going to talk about real estate.
So the real estate thing?
Yeah, we'll talk about that another time.
Oh, actually, I would be interested to know what you think about that because I don't know about that.
I'm not going to tell you. We'll talk about it another time. I want you to close, actually, by talking about something you mentioned in passing, which I think is interesting. And I say it because I think it was a field of mine in graduate school. I have to think about this carefully. Whether one of my fields was industrial organization. It might have been with public finance. I'm getting confused now. It was labor and IO, I think, yeah. And IO in Chicago in late 1970s, as you can imagine, was very different than modern IO. But you make the IO being industrial organization, the study of market structure and these kind of competitive issues we've been talking about. You make the point that the clamor over these monopoly issues and payment issues and market structure issues is not coming particularly from the industrial organization part of the profession.
Right. Yep. And there's some obvious reasons for that. So IO people have spent, especially empirical IO people, have spent a lot of their time, looking very micro, looking at the effects of specific mergers in specific industries, and not thinking so much about the overall picture, not thinking about the macro trends. So then you have what you've had recently is people from actual macroeconomics or labor, public finance, et cetera, coming in and saying, okay, let's look at the overall picture because we see these weird macro trends. We see slow wage growth. We see, falling labor share, et cetera, et cetera. Let's see if we can try to explain these. And then this is one of the things they looked at was industrial concentration because everyone knows this story of, monopoly, oligopoly, market power kind of stuff. We learn it in 101. And so they looked at that at a macro level, and the IO people are like, wait, hold on a second. That's not what we do. We just look at individual mergers. And so there's been this culture clash between the macro public finance labor people and the IO people because they are just, it's kind of incommensurate. They're looking at different levels of analysis. And now I want to open up some dialogue between these people, and I think that I'm one of the many people now pushing for more of a dialogue here because there are methodological issues with what the macro people are doing. They're finding, correlations that could have several different causations. They're, that people have raised some issues with some of their estimation strategies in some cases, and but then there's also issues with what the IO people are doing because you can't tell how. Looking at how one merger affects things doesn't really tell you how a giant wave of mergers or a more permissive attitude toward mergers might affect the whole overall economy. So these macro trends are actually really important and can contain information that can help you understand the micro stuff as well. So I think that both, they're kind of, grabbing two different parts of the elephant. You know that story, of course.
Sure.
And I think they're grabbing two different parts of this elephant, and that's a problem, and they need to talk to each other more. And that dialogue is now happening, and I think that pieces by people like me can help facilitate that dialogue by collating and gathering a lot of the different research that is being done by macro people, by labor people, by finance people, et cetera, in one place, and then hopefully getting some input from the IO people for future, rebuttals and discussions.
My guest today has been Noah Smith. Noah, thanks for being part of EconTalk.
Thanks, Russ. It's been a pleasure.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.